Welcome to this professional explainer on Section 165 of the newly minted Income Tax Act 2025. Today we're focusing on an absolutely foundational pillar of transfer pricing, determining the arm's length price.
So picture this, you're an Indian company and you're selling goods to your overseas subsidiary. How do you price that transaction correctly for tax purposes? As chartered accountants and tax professionals, pricing these transactions between a domestic company and a foreign subsidiary, or even specified domestic transactions, is a practical challenge you face every single day. If you price it too low, well, you're leaking tax revenue. But if you price it too high, you might face some pretty strict penalties.
Here is our agenda for today. We'll start by decoding the arm's length price, look at Section 165 and the new rules, see how to determine it in practice, go over compliance and forms, tackle some common practical issues, and finally wrap up with our key takeaways. Let's get right into it. Section 1. Decoding arm's length price. Under this new regime, Section 173A defines arm's length price, or ALP, very simply. It's the price applied, or proposed to be applied, in a transaction between persons other than associated enterprises in uncontrolled conditions. So, in plain English, it's essentially the fair market price that two completely unrelated companies would happily agree upon in the open market.
Now, before we dive deeper into the mechanics of this, we really need to clarify a massive structural change. The old Income Tax Act of 1961 relied on those sometimes confusing, overlapping concepts of a previous year and an assessment year. Well, the ITA 2025 completely simplifies this. We now have a single, unified tax year. The year you earn the income and the year it's assessed share the exact same reference. So if your financial year is 2026 to 2027, your tax year is simply 2026 to 2027. It's a huge relief for compliance.
And for those of you transitioning your practice from the old Act, the computation mechanisms that used to live in Section 92C of the 1961 Act are now officially governed by Section 165 of the 2025 Act. The primary objective is exactly the same, stopping profit shifting. But the structure, the reporting, and the terminology, they have all been extensively modernized.
Moving to Section 2, Section 165 and the rules.
Section 165, when you read it alongside Rule 79 of the Income Tax Rules 2026, gives us 6 specific methods for determining that arm's length price. We've got the comparable uncontrolled price method, the resale price method, cost plus, profit split, the very popular transactional net margin method, and a catch-all, other method prescribed by the board.
Now, here's the catch. The law is crystal clear. You don't just pick your favorite method, and you absolutely cannot test all of them just to cherry-pick the one that gives your client the best tax outcome. Section 165(2) mandates that you must select the most appropriate method, and this selection depends entirely on the nature of the transaction, the class of the associated enterprises, and a functional analysis of what is actually being done.
Let's look at Section 3, Determining ALP in Practice.
All right, let's take this from theory to reality. Under Rule 81, when you're applying a method like the transactional net margin method, you first have to identify comparable uncontrolled transactions. Then you take their profit level indicators, basically their margins, and you construct a data set by placing them in strictly ascending order, from the lowest margin to the highest. This is where the math really kicks in. If your data set has 6 or more entries, the law prescribes a very strict mathematical range. Your arm's length range begins right at the 35th percentile of your dataset and ends at the 65th percentile. So how do you actually apply this to your client's transaction? It's a simple 3-step process. Step 1, check if the actual transaction margin falls within that 35th to 65th percentile range. Step 2, if it does, you're golden. No adjustment is required, the transaction is deemed arm's length. But step 3, if it falls outside this range, let's say it's way lower than the 35th percentile, an adjustment is legally warranted, and you don't just bump it to the 35th. The new arm's length price has to be mathematically recomputed using the exact median of your dataset.
But you might be wondering, what if I have fewer than 6 comparables in my dataset? Well, in that case, the percentile range doesn't apply at all. Instead, you just use the arithmetical mean of the comparables. If the variation between your actual transaction price and this mean doesn't exceed 3%, then your price is perfectly acceptable as the arm's length price.
Section 4, Compliance and Forms. Because determining the right price is really only half the battle. The ITA 2025 and Rules 2026 totally overhaul the reporting system. Form 48 is here, and it completely replaces those old, narrative-heavy forms we used to fill out. According to the official FAQs, this is a major shift toward a highly structured, transaction-wise reporting system. We're talking standardized dropdowns to prevent subjective interpretation. Plus, aggregate transaction amounts will now auto-populate, and the form explicitly demands you capture the key elements of your underlying economic analysis directly within the form.
Now, here's a real game changer for efficiency. Section 166.9 introduces Form 46. This form lets you exercise a multi-year option. Basically, you can lock in the determination of your arm's length price for a single proceeding that spans 3 consecutive tax years. You file for the immediate tax year, and it automatically covers TY+1 and TY+2. Think of the compliance time that's going to save.
Section 5. Common practical issues.
Even with these clear rules, things can definitely go wrong in practice. A really common mistake under Rule 79 is improperly aggregating distinct transactions. You can't just lump royalty payments in with standard service fees. They need to be benchmarked separately. Another big issue is failing to make reasonably accurate adjustments for differences in accounting practices between your client and those comparable enterprises. And finally, if you neglect to maintain contemporaneous documentation by the specified date under Section 171, you will automatically trigger scrutiny.
And finally, Section 6, Summary and Key Takeaways. Let's recap what we've covered today. Keep these points in mind. Section 165 fundamentally modernizes transfer pricing. The old assessment year is completely gone, replaced by the unified tax year. Rule 81 strictly enforces mathematically precise percentile ranges for datasets with 6 or more comparables. Form 46 is your new best friend for locking in multi-year compliance, and Form 48 demands strict, structured reporting that leaves zero room for ambiguity.
As we fully transition into this new regulatory regime, the critical question you have to ask yourself is this: is your current transfer pricing documentation truly ready? Will it survive the rigorous scrutiny of automated transaction-wise reporting? It's time to upgrade your analysis to meet the 2025 standards.
The transfer pricing landscape is changing rapidly. Don't let your clients get caught relying on outdated methods. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.